Welcome to our deep dive, everyone, into the sometimes murky world of accounting scandals.
Murky is right.
You sent over this fascinating Wikipedia article on it.
Yeah.
And, wow, it's got quite the list. Enron, WorldCom, you name it.
Yeah, it's a real rogues gallery of corporate bad behavior.
It is. But, instead of just listing off all the scandals, which is kind of what Wikipedia does, we thought, let's try to figure out the why here.
Right, the why is always more interesting than the what.
Exactly.
Right.
What makes someone decide to just start cooking the books?
Well, you got to understand the pressures they face, the opportunities they see, and maybe even how they justify it to themselves.
Yeah. Is it pure greed, or are there other factors at play?
It's rarely that simple. There's always more to the story.
So let's back up for a sec and define our terms here. When we say accounting scandal,
Right.
what are we really talking about? It's more than just, a misplaced decimal point, right?
Oh, definitely.
Yeah,
It goes way beyond a simple error. We're talking about a deliberate effort to manipulate a company's financial records, to deceive investors and the public. It's like creating a fictional world where everything looks perfect on the surface, but underneath it's all smoke and mirrors.
And those mirrors can shatter pretty spectacularly.
They sure can. And the fallout can be massive. We're talking about billions of dollars in losses, shattered investor confidence, job losses, and even ripple effects that can impact the entire economy.
Right. The 2008 financial crisis, that had some accounting shenanigans tied up in it, right?
Absolutely.
Yeah.
A lot of it stemmed from shady accounting practices in the mortgage industry.
Wow. Okay, so the Wikipedia article talks about two main types of accounting fraud: misappropriation of assets and fraudulent financial reporting.
Right.
Can you break those down for us?
Sure. Let's start with misappropriation of assets. That's basically just a fancy way of saying theft. Someone's dipping into the company cookie jar for their own personal gain.
So an employee skimming cash from the register.
Exactly. Or maybe they're using company credit cards for personal vacations, or funneling money to a secret offshore account.
So it's kind of like robbing the company piggy bank.
Precisely. Now, fraudulent financial reporting is a bit more sophisticated. It involves manipulating the numbers in the financial statements to paint a rosier picture of the company's performance than what's actually happening.
So instead of pocketing the cash, they're messing with the scoreboard itself.
Exactly. It's like inflating your grades on a report card. You're not stealing anything tangible,
Yeah.
but you're misrepresenting your true academic standing.
So a company might overstate its revenues to look more profitable?
Right. Or they might underreport expenses or hide debts to appear less risky. It's all about creating a false impression of financial health.
And they do this through fake invoices and stuff, right?
That's one way. They might also record fictitious sales, manipulate accounting entries, or use complex transactions to obscure the true nature of their financial dealings.
Okay. Now we're getting into the real deception here. But why? Why do people do this? Are we talking about just a few bad apples?
Well, there's a model called the fraud triangle that helps explain the factors that contribute to fraudulent behavior.
Yeah. The article mentioned that. It sounds kind of ominous.
It can be. The three elements of the fraud triangle are pressure, opportunity, and rationalization.
Okay, so walk us through that.
Imagine a pressure cooker on the stove. The pressure inside builds and builds, and if there's a weak spot like a faulty valve, it's going to blow.
So how does this apply to accounting scandals?
Well, let's start with pressure. Think of a CEO who's under immense pressure to meet those ambitious earnings targets set by Wall Street analysts. Their job, their reputation, their bonus, it's all on the line.
So they feel like they have to hit those numbers no matter what.
Exactly. And that pressure can lead to some pretty bad decisions.
And what about opportunity? Where does that fit in?
Opportunity arises when there are weaknesses in a company's internal controls. Maybe their accounting systems are outdated, or there's a lack of oversight, or there's just a culture that turns a blind eye to questionable practices.
So if the pressure's high and the opportunity's there, that's where the rationalization comes in.
Precisely. People need to justify their actions, even to themselves. They might convince themselves that what they're doing is harmless, that they're just borrowing the money, or that everyone else is doing it.
It's like that saying, the first step towards solving a problem is denying you have one.
Exactly. And those justifications can be incredibly convincing even to people who are otherwise intelligent and ethical.
It's like a perfect storm of factors.
It really is.
Yeah.
The pressure, the opportunity, and the rationalization, they all work together to create a breeding ground for fraud.
It's a fascinating and kind of scary interplay of factors. But let's delve deeper into the individuals themselves. Do the motivations differ between like executives and regular employees?
Oh, absolutely. Executives at publicly traded companies, they face immense pressure to keep those stock prices high.
Right.
Their compensation, their job security, even their reputation, it's all tied to how the company performs on the stock market.
Yeah, it's like they're constantly under a microscope with analysts and investors just scrutinizing every move.
Exactly. And that pressure can sometimes lead to what's known as earnings management.
Earnings management. That sounds kind of shady.
It can be. It's a slippery slope where executives start manipulating earnings to meet expectations, even if it means bending or breaking the rules.
So they're not always outright stealing money, but they're still distorting the financial picture.
Right. Think of it as playing a game with the numbers. They might delay recognizing expenses, or accelerate revenue recognition, or even create those off-balance sheet entities to hide liabilities.
Off-balance sheet entities. Now, those sound shady.
They can be. It's a way of keeping certain assets and liabilities off the company's main balance sheet to make it look financially healthier than it actually is. Enron was notorious for using these complex structures to hide billions of dollars in debt.
So it's a way of masking the true financial risk.
Exactly. And when these schemes unravel, the consequences can be catastrophic, not just for the company and its investors, but for the executives themselves.
Speaking of consequences, the article mentions some pretty hefty punishments for executives involved in these scandals.
Oh, yeah. The legal and reputational repercussions can be severe. We've seen executives facing criminal charges, hefty fines, even jail time. Their careers are often ruined, and their names become synonymous with corporate greed and deception.
It's a steep price to pay. But what about regular employees? What motivates them to commit fraud?
Well, unlike executives, employees are often driven by personal financial pressures.
Mm-hmm.
They might be struggling with debt, facing unexpected medical bills, dealing with addiction.
So it's not always about greed, but sometimes about sheer survival.
Yeah, in some cases, it's a matter of people feeling like they have no other choice. They see an opportunity to solve their financial problems by taking what they believe is a small amount from the company.
Justifying it as like a temporary loan or something.
Exactly. But even small thefts can snowball into major scandals.
Right.
And it's not just about the financial impact. Employee fraud can be incredibly damaging to morale and trust within an organization. It creates a culture of suspicion where everyone's questioning each other's motives.
It's like a poison that spreads throughout the company.
Exactly. So whether it's an executive driven by greed or an employee facing financial hardship, the consequences of accounting fraud can be far-reaching and devastating.
It's a stark reminder that behind all those numbers and financial statements are real people's lives. Speaking of consequences, the article mentions the Sarbanes-Oxley Act, or SOX, as a major regulatory response to the Enron and WorldCom scandals. Can you tell us more about that?
Of course, SOX was a landmark piece of legislation passed in 2002 aimed at restoring investor confidence and preventing future accounting scandals. It introduced a whole slew of reforms focusing on strengthening corporate governance, enhancing auditor independence, and improving the accuracy and reliability of financial reporting.
It sounds like a pretty comprehensive overhaul of the system.
It was SOX imposed stricter requirements on companies, requiring them to establish and maintain effective internal controls over financial reporting. It also created the Public Company Accounting Oversight Board, or PCAOB, to oversee the audits of public companies.
So it's not just about companies policing themselves anymore.
Right. SOX introduced a new level of external oversight, with the PCAOB setting auditing standards, inspecting accounting firms, and disciplining auditors who fail to meet their responsibilities.
It seems like a pretty significant step towards greater accountability. But the article also mentions some debate about SOX's effectiveness. Has it actually lived up to its goals?
That's a complex question. SOX has undoubtedly had a positive impact. It's led to improvements in corporate governance and internal controls, and it's made companies more accountable for their financial reporting.
So it's had a deterrent effect.
To some extent, yes, but it's not a foolproof solution. Human nature is complex, and where there's a will to commit fraud, there's often a way.
And some critics argue that SOX is overly burdensome, especially for smaller companies.
That's a common criticism. The compliance costs associated with SOX can be substantial, and some argue that it stifled innovation and made it more difficult for smaller companies to go public. There's a constant debate about finding the right balance between regulation and allowing businesses to operate efficiently.
It's a reminder that there's no easy fix for a problem as complex as accounting fraud.
Exactly. And this leads us to another interesting development mentioned in the article, the shift towards more principles-based accounting standards.
I was curious about that. It sounds like a pretty fundamental change in approach.
It is. The idea behind principles-based accounting is to move away from rigid rule-based standards and instead focus on broader principles of transparency and ethical conduct. It's about empowering accountants and auditors to exercise professional judgment rather than just blindly following a checklist.
So it's less about ticking boxes and more about understanding the spirit of the rules.
Precisely. It's about encouraging a more holistic approach to financial reporting, where the focus is on presenting a fair and accurate picture of the company's financial position, even if it means going beyond the letter of the law.
It sounds like a noble goal, but I imagine it also comes with its own set of challenges.
It does. One of the main criticisms of principles-based accounting is that it can be too subjective, leaving room for interpretation and potentially making enforcement more difficult.
So it could lead to inconsistencies in how companies apply the principles.
Exactly. And it puts more responsibility on the shoulders of accountants and auditors to make judgments based on their understanding of the principles, which can be challenging in complex situations.
It seems like there's a constant tension between trying to prevent fraud with strict rules and allowing for flexibility and professional judgment.
That's the crux of the debate, and it's a question that regulators, accounting professionals, and investors are grappling with as the financial landscape continues to evolve.
Speaking of evolving landscapes, the article also touches on the role of technology, specifically AI in detecting fraud. It seems like this could be a game changer.
It definitely has the potential to be AI, and machine learning algorithms are incredibly powerful tools that can analyze vast amounts of data, looking for patterns and anomalies that might indicate fraudulent activity.
So it's like having a digital detective constantly scrutinizing the books.
That's a great way to put it. AI can analyze financial transactions in real time, flagging suspicious activity and helping auditors focus their attention on the areas that require further investigation.
It sounds incredibly efficient, but are there any limitations to using AI for fraud detection?
Of course. While AI can be incredibly effective at identifying patterns and anomalies, it's not a silver bullet. You can still be fooled by sophisticated fraudsters who know how to manipulate data or create transactions that appear legitimate.
So it's an ongoing arms race between technology and human ingenuity.
Exactly. And it's why human oversight remains crucial. AI can be a powerful tool, but it's important to remember that it's a tool that needs to be used responsibly and ethically.
That's a critical point. We can't just blindly trust algorithms to solve all our problems. We need to ensure that human judgment and ethical considerations remain at the forefront of financial reporting.
Right, and that highlights a crucial point. While AI can be an invaluable tool in the fight against fraud, it's not a substitute for human judgment. We still need skilled professionals who can interpret the data, investigate red flags, and understand the nuances of complex financial transactions.
It seems like the key takeaway here is that technology and human expertise need to work hand in hand to create a truly robust system of fraud detection and prevention.
Absolutely. It's about finding the right balance between leveraging the power of technology and ensuring that human judgment and ethical considerations remain at the forefront.
Thinking about all these scandals mentioned in this Wikipedia article, it makes you wonder, are there any common threads or patterns that link them together? Aside from the fraud triangle, are there any underlying factors that contribute to these massive breaches of trust?
Well, one recurring theme is the role of corporate culture. The values, beliefs, and behaviors that shape an organization's decision-making processes.
Right.
They play a huge role in either encouraging or discouraging ethical conduct.
So it's not just about having rules in place, it's about creating an environment where those rules are actually followed and upheld.
Exactly. Think of it this way. If a company's culture prioritizes profits above all else, cutting corners and bending the rules can become normalized. It creates a breeding ground for unethical behavior.
It's almost like a slippery slope. What starts as a small transgression can escalate into something much bigger if the culture allows it.
Precisely. And that's why it's so important for companies to foster a culture of ethics and compliance. It's about setting the right tone from the top, promoting transparency, and encouraging employees to speak up when they see something wrong.
The article touches on the importance of whistleblowers in exposing fraud. What role do they play in this whole ecosystem of accountability?
Whistleblowers are absolutely essential. They're often the first line of defense against fraud. They're the ones who see what's happening on the ground, and they have the courage to speak up, even when it's risky.
But speaking up can be incredibly difficult. It takes a lot of bravery to challenge authority, especially when your job might be on the line.
You're absolutely right. That's why it's crucial for companies to create a safe and supportive environment for whistleblowers. They need to have a confidence that their concerns will be taken seriously and that they won't face retaliation for speaking up.
It sounds like building a culture of trust is essential both for preventing fraud and for encouraging people to come forward when they see something wrong.
Exactly. And that trust needs to extend beyond the walls of the company. Investors, regulators, and the public need to have faith that companies are operating ethically and transparently.
It's all interconnected. The trust within the company, the trust between the company and its stakeholders, and ultimately the trust in the entire financial system.
You've hit the nail on the head. These accounting scandals, while devastating, serve as a powerful reminder of the importance of trust, transparency, and accountability in our financial system.
So as we wrap up this deep dive, what's the key takeaway you'd like our listener to ponder?
Well, I think it's important to remember that accounting scandals aren't just abstract events that happen in the world of finance.
Right.
They have real-world consequences for real people, employees who lose their jobs,
Hmm.
investors who lose their savings, and communities that suffer economic hardship.
Absolutely.
But these scandals also offer valuable lessons. They force us to confront the flaws in our systems, to question assumptions, and to demand greater transparency and accountability from those entrusted with our financial well-being.
It's a reminder that we all have a role to play in ensuring the integrity of our financial system. Whether we're investors, employees, or simply concerned citizens, we need to be vigilant, informed, and engaged.
Absolutely. And remember, knowledge is power. The more we understand about how these scandals happen, the better equipped we are to prevent them in the future.
Well said. Thanks for joining us on this deep dive into the world of accounting scandals. We hope you found it insightful and thought-provoking.
It's been a pleasure.
And to our listener, remember, stay curious, stay informed, and stay vigilant. Until next time, happy diving.